International, surprise, surprise. Guess what we done told you? We done told you that US was pricier than international. So, international equities, did I?
It's like a leprechaun is giving a recap over there. I mean,
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Skippy, Skippy, Skippy. Skippy, Skippy, Skippy. Skippy, Skippy, Skippy. Skip, 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 skip. What's that from?
I don't know. I thought it was Skippy, Skippy, Skippy. Can't you see?
Skippy, Skippy, Skippy. Can't you see? No. That was from Mario.
Oh, yeah. Okay. Yeah.
That's right. But I could do yours. Okay. Skippy, Skippy, Skippy. Can't you see how the S&P don't favor me?
What's happening?
I got all kinds of songs up here.
Welcome all to our annual year in review episode where we get to talk about what we buy and sell. It's so exciting.
Oh, it's so exciting. So exciting. I love you. We talked about last week how I love the beginning of the year. It's wonderful. My wife and I had a 3.5-hour financial summit on New Year's.
This is the
Day.
world's most depressing. I watch football. You look at spreadsheets.
So I'm sitting there on my kitchen counter with a projector, because we have a projector that's projecting up financials, budgets, stocks, returns, all kinds of things. And my phone is blowing up. People are like, "Are you watching this ASU game? It is insane." I got to put on Do Not Disturb because a player is trying to talk about budgets.
I think the show's been going 4 years, but after hearing what you did on New Year's Eve, I think it's officially canceled. I think this is over.
It could be. P. Diddy and Doogles canceled.
I mean, I'm the value investor over here. I'm supposed to be like, no, but I'm actually outliving my life, enjoying my means, and you're looking at spreadsheets. This is so depressing. All right, on New Year's, we are watching the Ryan Seacrest thing, right?
New Year's
and
Eve.
my middle schooler pointed out that Kesha performed. The Kesha song has changed its lyrics. I mean, the ramifications are everywhere because you can't mention depressing stuff.
Anyway, all right. That's not what this is about.
That up, Doogles. Great job.
That's not what this is about. Why are you taking us off topic?
All right. We are going to get to it soon. I'm not even going to, I can't reveal all the things, but I looked at 32 names, 32 different stocks, almost made the list. Wow. Ended up with only 5. We're going to talk about what that means for me because 5's less holdings than I prefer. So
you prefer 6?
Thanks there. And the founding dates on these companies, man, something special. I can't wait to talk about it.
Oh my goodness. So the way that you hear this episode is by becoming a premium member, an annual premium subscriber. SkippyDoogles.supercast.com. I roll with Skippy Doogles. That is how you listen to this episode. Or we're probably going to talk about one thing. You'll hear some music, and we'll go into some of the best clips from the year if you are not a subscriber. So you'll hear that if you're not a subscriber. But become a subscriber, you can hear the full episode.
That's right. No pressure, y'all, but we like to talk about our research recommendations, and it's a great way to support the show. All right, the 2 things we are going to talk about, I think, first is really quick. I think this week, could have been last week, is the official time where the price-to-book ratio of the S&P 500 eclipsed its 1999 peak. And I know book value means a lot less in a technology-heavy intangible assets world. It still is like, gosh, and I know you guys are sick of us being like, oh man, have you looked at how expensive the average stock in the US market is, or like the average index in the US is? But man, it gets me somehow.
I know. I do feel like we're like the grandpappies. You know, grandpappy with the slippers on in the Barca loungers, like, do you see the price of coffee? It's so expensive these days. Back in my day, that's what I feel like we're like. However, listen to your grandpappies.
I mean, I
don't listen to your grandpappies.
No, I don't know how to respond to that. Yes, I'm a I'm a grumpy old man complaining
Yeah.
about how expensive things are. Yes,
You know, to be fair, I've known you for 25 years and you've always been that way.
it's true. It's true. All right. The other thing, we will not do this justice on the Substack this week, which you can check out all things related to this show, skippydoogles.com. Oh, there's this AQR piece from our boy Cliff, and this was
Speaking of
very
grumpy
humorous.
old men.
Oh yeah, yeah. He, I'll just set the stage and then I'll let you get into it. He wrote this article as if it's 2035, so as if it's January 2nd, 2035, and he wrote it as if private endowment is looking back on the last 10 years, and with the humorous twist, tells you exactly what happened in the last 10 years, which obviously, since he wrote it in 2025, means he's kind of predicting the future for what the next 10 years look like. And I got to give a shout out to our friend Adam here and his listener mail a couple weeks back. It has a mean reversion tilt to it, right? Which I loved. The humor is incredible, and you should read this. Like, if you know anything about private equity and crypto and international equity, it's just so good. I truly enjoyed every second of it.
So we want to hop into this thing?
I mean, just hit the highlights.
Yeah.
I think.
So he goes through U.S. equities, bonds, international equities, private equity, and is that it? Crypto.
Yeah. And crypto's the best.
Crypto's the man with the hairy chest. So here's what we do. U.S. equities, he goes, you did what we thought you were going to do, right? Like we said, Cape's really high in 2025. Cape's this high. Your next 10 years is going to be stinky doo-doo. And guess what? You basically returned a little bit above what risk-free cash did. So stinky doo-doo.
Mm-hmm.
Bonds, he said, you know what? Inflation never got back down to that 2% target. Inflation just kept staying in the 3 to 4% range.
Yep.
And so bonds, international, surprise, surprise. Guess what we done told you? We done told you that U.S. was pricier than international. So international equities did I.
It's like a leprechaun is giving a recap over there. I mean,
into the rainbow. And then one of my favorite lines is actually within private equity. Well, I'm trying to find it, but he says something like, he goes, private equities, turns out, are still equities. Like it was something like that. I was like, that was a great line.
Oh, and he throws shade about all the volatility laundering. I mean, if you don't read Cliff, this doesn't make a ton of sense to you, but it's just so funny. It's so funny. So my favorite is actually crypto. He says like, this is from the perspective of an endowment, right? He says like, our friends kept talking about some computers solving magic equations somehow being worth money, and then we saw it be worth 100K, referring to Bitcoin. So we just doubled and then tripled our allocation, right? That turned out to be a very bad decision. And then at the very end, he goes, the one thing we did right is our allocation to Fartcoin. Yes. And talks about how in his hypothetical letter here, Fartcoin was the shining star of all performance, and it really saved the endowments behind it. It's just
here's what he does say fun. Though. Here's what he does say is that next year Bitcoin goes to 250.
Yeah, which is completely made up.
I'm just saying, double down, baby.
Okay, I'm sorry. I'm gonna read like 4 sentences. Of course, we gave back any gains from our ingenious 10% Fartcoin allocation when many of our active stock pickers loaded up on the stock levered Bitcoin play. He's referring to MicroStrategy here. It turned out that paying double the very high price of Bitcoin for essentially a Bitcoin closed-end fund wasn't arbitrage as we were told it so. Also, it turned out that Bitcoin didn't have any actual yield, at least in the sense anyone has ever used the word yield since the Roman Empire. The shade being tossed here in multiple directions is so the whole thing is like this, guys. Read it. It's so good.
It's so good. So good. It'll be on the Substack. You know how, so he says endowment. Let's just say this is Princeton's endowment.
Mm-hmm.
Whoever's running that fund had to have been like the mythological fund he's talking about here. I'd have been like, do we have to line by line tell our LPs or our people, whoever our board,
Mhm.
do we have to tell them what we're investing in? Why are you asking? I just need no. Don't worry about why. But do they have to know every allocation? Because one of the lines says fart.
Oh man, fun stuff. I was talking to my son last night. I think we may be picking up some Fartcoin the hilariousness of it all.
Good Lord.
Um,
In
I
his
mean, to
college
own
fund?
like 10
In his college fund?
coins? No, because you can't even buy it on a reputable exchange, right? Like you have to do voodoo magic to even get there.
You
But
can get that hawk
come
too.
on now.
You can get that hawk too in the IRA.
No, you can't. Oh my goodness.
Did you see the that tweet that I sent to you from it was like July or August? There was somebody right after the Haktua Haley or whatever her name is, right after she got famous. Famous. I'm putting that in quotes. Right after that happened, somebody tweeted and goes, "It looks like she is hitting the peak of her 15 minutes of fame, which
Mhm.
means one of three things are about to happen." And the first thing they listed was a crypto scam. I was like, that was pretty good. This was like in July, whenever it happened.
Excellent work. I didn't realize the timing of it. So I didn't realize it had forecasted this.
Oh yeah, really good. Just like Cliff.
It's great. All right. I think we're going to hop into it. So thanks for hanging out. Enjoy the yearly recap. Y'all, we appreciate you supporting the show. Also, New Year is a great time for new resolutions. Great time to share the show with a friend. If you're into that, we'll talk to you soon.
To hear this full episode where Skippy and I talk about what we sold last year, how we performed last year, and what we're buying for this 2025 investing year, please go to skippydoogles.supercast.com and sign up for the I Roll with Skippy Doogles subscription. Otherwise, what you're going to hear for the rest of this episode are what you told us were your favorite clips, highlights from this past year. Thank you, everybody. Appreciate you listening. Reaching in the fishbowl, came across this post by Li Lu from years ago, a few years ago, called The Practice of Value Investing. Li Lu breaks down here. So, and this was taken from a talk that he did in China, and then turned it into like the transcript, basically into a post, is what this is. So he's talking to folks over in China, and what he wants to do is he says, I came and I talked to y'all before. I came to the school and I talked about value investing. What I did not talk about was how to do it. Like, what are the principles in practice? That's what I want to talk about today. What he lays out are baseline concepts, which I think is always good to get back to first principle fundamentals, and then a few points around each. So the four tenets that he lays out. One, stocks confer part ownership of a business. They are not just pieces of paper to be traded. Check, check. Number two, margin of safety. At its heart, investing is about making predictions of the future. However, we can only obtain some indication of probabilities as the future is inherently unpredictable. Therefore, we must leave ourselves a margin of safety. Check, check. Number three, Mr. Market. The market is there to serve you, not to guide you. Check, check. Number four, circle of competence. Investors must build their own circle of competence through long-term study and then stick within it when investing. A check, check. So, so those are the four principles. And then he kind of hits on the part ownership and margin of safety briefly, and then says, okay, can we just all agree on those two things? Now I want to spend most of the time talking about Mr. Market and the circle of competence. That's mostly what he ends up doing. And I have a few Mr. Market points that I want to hit on, and then one investing versus speculating point. So here's when he talks about Mr. Market. Here's what he discusses. He says, what Mr. Market does, he wakes up in the morning and he yells out a whole bunch of prices. He's like, oh, this is $2 and that's $7 and that's $10, blah, blah, blah. He yells out prices. But sometimes he gets all worked up and he gets overly optimistic or overly pessimistic, right? This is classic Benjamin Graham, Mr. Market description. He goes, so like when you look at it in that way, it sounds easy. You just sit back and wait till he gets overly optimistic or pessimistic because we all know what's going to happen. But in practice, it's harder. Now I'm going to read this part verbatim because I think it's solid. But as soon as you begin work and enter the market, you will realize that there are real people on the other side of every transaction. These people are all well educated, have more money than you, have more power than you, and have more experience than you. They are highfalutin, highly accomplished, and often in positions of seniority. The reason that he lays that out, and I wanted to read it verbatim, is because that's what starts to mess with the psychology. Is when you go, these people know more than me, they have more money than me, this is the smart money, and then you start to see this optimism or pessimism go on for too long. That's when you go, oh, okay, maybe it's not overly optimistic or overly pessimistic. It's just truth now. And you don't sit within the confines of what you know about Mr. Market.
We read the exact same piece. I highlighted the exact same lines. That was the piece I was going to read verbatim. Because he does such a great job of outlining his value investing principles, which are different from anyone else's value investing principles, but very similar concepts, right? And I love that they're unique, and he's not just taking someone else's talking points. But then that point, especially for like a individual retail investor, is so important because it's very easy to sit in business school or to read The Intelligent Investor and say, yeah, I know the market's irrational. Like the first page of any good investing course is to pull out a newspaper back when newspapers are relevant, say, pick your favorite stock and look at the 52-week high and low. And they're typically about 50% different, sometimes more, and go, explain that to me. It's only a 1 year's time frame. Why is there so much variability? Right? It's largely because Mr. Market. It's largely because not all those prices are rational. So he closes with summarizing value investing in life. Can I read this piece too? Since you stole my thunder here, Douglas. And by the way, are you a closet value investor? What's going on here?
No. We can. Is that a real question? Because I can go into that, or do you want to read your verbatim?
Let's spend a little time on. You seem to really enjoy brilliant value investing pieces like this.
I do, because I think the principles are still very important, even when you make fun of me for very good reason. Like I deserve all the boots in my face. When you make fun of me about buying Twilio, I'm not buying Twilio because I'm calling it like a value stock. I am buying Twilio because of what I see from like a growth stock potential. But when I think about when I would buy in my non-model portfolio, when I think about when to buy these stocks, I do use versions of value investing principles. I'm not looking for PE ratios that are 4 necessarily or anything like that. But I think about like margin of safety. Like this thing has been beaten down so much that, and here's a big difference between what you do and what I do. There's lots, but here's one with Twilio specifically. Either it's going to completely fail or they're going to take off. You buy things that are like, it's highly unlikely the thing's going to completely fail. I'm like, this thing might fail. Like it legitimately still might fail. So I use the principles even in the growth, quote unquote, growth investing. And that's why I think Einhorn was saying this, and other people have said it too. They're not completely divergent philosophies.
Not at all.
Yeah. All right. Yeah. Speak on it.
Okay. He says, is value investing a kind of faith? I think it might be because it manifests itself in a set of beliefs. You aren't willing to exploit others. You won't participate in zero-sum games. You will pursue your fortune in a way that also benefits society. That's clearly Munger influence right there. That's me adding that. You won't be someone who counts on gambling to make money. The next time you see speculators, you won't need to wish them good luck because you know luck can't last forever. Instead, you'll simply wish them to have fun. When people go and play at the casino, they try to buy happiness, but it's a waste of money because you can't buy happiness. It even seems like a waste to go to the casino because so many people come back feeling down and out. In the worst case, you might become addicted and lose it all. Again, Munger influence there. If you say you're only going for some fun, that's okay. But if your values are different than those of a gambler, you will keep your distance from gambling in the stock market. You will not invest in things you don't understand. And remember that understanding means being able to make accurate forecasts over a long period of time with some high degree of confidence. If you can't satisfy this condition, then you won't do it. So yes, from this perspective, value investing is a set of beliefs. So yes, you can also call it a faith.
Boom.
Boom.
I love it. I love it. Boom. Boom, boom, boom.
It's fun. It's a really good transcript. It's tough to find. Props to you for finding the whole talk, because he's a very intelligent man and a great investor.
Yeah. Solid. Thank you, Lilu. Should we talk about another of your favorite investors? Should we reach in the
I don't know
fishbowl?
that he's one of my favorite investors. He's one of my favorite characters.
He's top 50. Top 50 of your favorite investors.
Top 50. Sure. Top 50.
Reach into the fishbowl and Cliff Asness, who we're talking about, who's come up a bunch. He's probably the most talked about, aside from maybe Kathy Wood, but most positively talked about investor on this show, because he comes out and says stuff, mostly is what it is. He had an interview with Meb Faber. That's the setup here. And talked about a couple things that gave you some confirmation bias and some things that also were a little bit more novel for you. Give some flavor to it.
What did you think of the part where he said, Skippy's 100% right about the simple path to wealth, and I fully endorse the Skippy and Doogles show? What did you think about that part of it?
I thought it was interesting that it followed directly with him saying that his fund has lost half of its value.
Hey, he did. I'm joking. He did talk 100% equities.
He did. No, he really did.
What do you think?
I think that, so what he's saying is very similar. This is your point. It's very similar to what you were saying. I thought it was well articulated, and he was saying, if you say that something has performed well for the last 30 years, and therefore I'm going to put 100% of my money into it for the next 30 years, this is the part that I loved. He says that's silly. And the way when he's making that argument, he said where he takes it is he goes, okay, so what's the individual stock that has performed best over the last 30 years? And would you put all of your money into that individual stock? If not, it's the same logic.
And why is 500 the magic number? So if you just say, oh, I just want to look at all the asset classes, which is effectively what these FIRE guys have done. Financial independence, retire early is the FIRE acronym there. And they've just said, well, like, dude, look at the S&P over the past 30 or 50 years. It's like, well, why not the top 300 stocks, or why not the top 1,000 stocks? Those are going to be the best performing. Or to his point, dude, have you seen what NVIDIA has done? Look, I'm going to do some back testing. It's all going to show that if I had 100% of my money in NVIDIA, I will be rich. And NVIDIA, Doogles, never crashes. Look at my back test ended in April 2024.
I love that you're using the word back test with an individual stock. So you're pulling up a stock chart.
This is the point. That's what people are effectively doing. And they're being like, the S&P 500, best thing to do in the last 30 years. It just completely loses the context of where we sit today, which is so important.
I think it was well articulated. I get your point. It does come back to the simple path to wealth point. I agree with that. And my point around it was just simplicity, but I agree with this. I agree with this point. And he was saying that he says that people oftentimes will get the diversification point when it comes to stocks and bonds, but it starts to break their brains when it comes to leaving the US. He goes like that seems to be the line for some reason for folks, that foreign investments just do not seem to register for people because America. Mm-hmm. I get it.
What else stood out in the interview to you?
The other thing that you raised with me via textual message, that was the idea of fundamental momentum. So it's saying typically with momentum investing, you look at the price. You look at price momentum. What's moved over the last 3 months, 6 months, 12 months, and then momentum has a tendency to continue according to momentum lore. This is saying,
I mean, the back testing on that is strong. And the reason I think of you when we talk momentum is your quantitative strategy has a component of that.
Yeah.
So you make money based on that proven trend.
Yep. And This is saying fundamental momentum is when you look at not the price, but what its like earnings surprises. Like what's the momentum on how many earnings surprises has it had over a certain amount of time? So you look at something that's based off the fundamentals, but the momentum of that fundamental movement. So you could think about this as saying this company spits out loads of cash or cash per share, whatever metric you want to look at. And if it does that over a certain period of time, you're saying its fundamentals are actually improving over time, not just the price. I think it's an interesting concept.
Yeah, and he shows that there's a limited correlation with price momentum, and so you can build a strategy around that. It's funny because I don't run like backtest behind the scenes that says there's a positive earnings trend and like formally spit that out of a model. But often when I'm looking at depressed companies, you're looking for positive trends with free cash flow, earnings, everything else. And so in a way, I kind of do it. It just really registered for me because I know that momentum works, momentum investing works, but I always get freaked out when I get disconnected from the fundamentals. And it seems like there's a way to marry those that could work for my investor psychology and still like have more benefit on the positive upside of the momentum trend.
I like it. Thank you, Cliff.
It was good. Check that out for sure.
I'm going to stick on NVIDIA for a moment. Is that okay? Or do you want to go somewhere else?
Okay. Yeah.
All right. Fishbowl reaching. Going to pull out NVIDIA 8 years ago today. I don't actually know, but I'm going to say 8 years ago this hour, Jensen Huang showed up at OpenAI with an AI chip 8 years ago. There are a few different points to this. One that I like is that it was 8 years ago. There's so many times in business where it feels like something's an overnight success. Like it was like, oh, OpenAI released ChatGPT, and now NVIDIA has like, well, we should create the chips for that. And then, it takes off. This was 8 years ago. You got to plan ahead in business, people. You got to plan ahead. So that's one point, but that's not the main point of this. The main point of this.
It's planting seeds, right?
Yeah,
you're
exactly.
growing a bunch of trees, right? He planted the seeds at least 8 years ago for the massive run up that's in the stock that's happened in the past 12 months.
Yeah. Because people also act like AI was just invented 18 months ago. And when I say people, I don't mean everybody, right? I'm not trying to say that universally. It's just that
you mean AI, disparagingly all the people you hate.
Yeah, deplorables. No, I'm joking. All right. So that wasn't the main part of this. So this is a tweet that someone sent out. And then they laid out 4 principles that Huang says that he lives by, runs NVIDIA by. And I thought these were interesting and worth talking about. So that's really what we're talking about here. The first is have low expectations, but high standards. This, at first, I was like, come on, Jensen. I thought you was my boy. But I get what he's trying to say. What he's trying to say here is that oftentimes, in his view, people that have high expectations also have low resilience because they come into a situation. I think he was talking to like Harvard or Stanford or like some kind of Ivy League or semi-Ivy League school class, I think is what he was talking to in this little piece. And he's saying, like, all y'all, you expect that when you leave here, you're going to have high paying jobs. Your like careers are going to be paved with gold ahead of you. And if that doesn't happen, then you end up flat on your butt because you don't know how to handle that. Whereas if you have low expectations, but high standards, you have more resilience because little bumps in the road, they're just like little bumps in the road. You go, whatever, but you still hold yourself to a high bar. That's what he's saying there. Thought it was an interesting way to look at it. I've never thought about it that way. Next, he said, no task can be beneath you. If the toilets need to be cleaned, clean the toilets. And his point here is with regard to a company is that there are often times where someone will be like the big boss person and they'll go, no, it's your job to do that spreadsheet. It's your job to create that PowerPoint, whatever it might be. And he goes, no, like if someone needs to take notes, you take notes. Like the notes need to get taken. So do the dag nap thing.
It kind of speaks to low expectations, right? Like you're not above it all.
Yeah, I think that's right. The third, structure your company or your department the way it needs to get structured and not according necessarily to a template that exists out there. He says oftentimes what happens is people go, well, we run a chemical company and chemical companies have this org structure, so let's just have the org structure. And he goes, you have to understand the DNA of your company, the culture of your company, and what best works for not just the organization of the company, but the moment in time. What structure do you need for this moment in time? I think this is right and also can be kind of dangerous.
It's super dangerous.
Speak on it.
So I love the way his company is structured, but everyone reads those articles when it's the best performing stock of the last 24 months and takes it as gospel and says everyone should do it. If I remember correctly, the way his individual directors are structured, he doesn't do one-on-ones with them. He also has 24 direct reports. Like it's super unique. And basically, I think they exchange written communication once a week, and the only time they talk is if he or they flag that like something is being escalated. It's something
it's
like
a lot
that,
of
right?
autonomy. A lot of autonomy. Yeah. Or maybe not even autonomy. It's like beyond autonomy. It's not quite to Tony Hsieh's holacracy. Not quite, but it's trending in that direction.
And it's awesome. I love that he was creative enough to build a company that works for the way he works. I think that's the most important thing, but also very often, as I like work with small companies and then as they grow to mid-sized companies, the commonalities of your mid-sized company are there for a reason. Like that level of rigor and structure provides benefit. And if something works for 90% of companies, my only point is there's probably a reason that 90% of companies use it.
And another side of this is something that you say all the time with regard to investing is when Warren Buffett says, do a certain thing, like Warren Buffett can do that. That doesn't mean that that's right for you. It's very similar to what you're saying here. He's like, look, if you are Jensen Huang, then structure your company how you need to structure it. You know what I mean? If you're Michael Jordan, do the killer crossover and then pull up. If you're Michael Jordan, jump from the free throw line to dunk. Why doesn't everybody just jump from the free throw line to dunk? I get that point.
Because they can't. I mean, I can't even wear a leather jacket and look as cool as Jensen. So I'm not going to try and run my company this way.
I will say, though, that I am just as successful jumping from the free throw line to dunk as I am jumping for right underneath the basket.
It's a great point, actually. Yeah.
So why not jump from the free throw line? Last, environment is the product that makes the product. I do really love this one. This is about company culture and how you structure your company. He's saying that the environment of your company is the first product to create. And that environment then enables you to create the products that you make. I think it's a really cool concept. I think it's fairly meaningless to most people. It's just like a Sun Tzu type phrase, but I also think that it's true.
Yeah, I like it.
Vidya, baby. Can we start off with David Tepper?
Please.
I want to play a part of an interview with David Tepper on Squawk Box to kick things off. That cool with you? David Tepper, he's talking about Chinese stocks. They've been taken off over the last few days. There's a China stimulus package, which we can talk a little bit more about. And that's what he's discussing here about these Chinese stocks that he has seemingly bet more on at this point. So that's the context. And now we're going to take a little listen.
And for those who don't know, David Tepper is a hedge fund manager, very successful, owns the Carolina Panthers. To give you some idea of how successful his investing career has been, he has multiple years where he's been rated as the highest paid hedge fund manager with compensation around $2 billion. And that is for a 12-month period. He's done all right.
There it is. He's done all right.
You can look at these names, and you're talking about single-digit PE multiples with double-digit growth.
But you think there's
and wait a second.
Yeah.
This is the other thing. You have some of these stocks with 50% cash. Some of these things you just put up on the board, 50% cash, 20% cash, 30% cash. And that cash, depending how the Chinese currency goes, maybe if the Chinese currency is really strong, they'll want them to buy back.
Okay, so David, let me ask you.
They're asking, did you see this thing? Buying back stock, when companies buy back their stock.
Right, but you're a hedge fund. How do you hedge your risk? What's the counter bet that you put on that, just in case?
You know what? You know, I'm sitting here in a suit. My counter bet is that I don't care.
That's so good. That is so good. There was in that like 1 minute, it was a little under 1 minute that we played. There was a little bit of Skippy and a little bit of Doogles. in that one 45-second clip we just played, and I was loving it.
some fundamental analysis and the phrasing still gets to me is like, I don't know why he had to say I'm here wearing a suit. He should have just said like, the deals are so good, I don't care about hedging my risk. I think that's effectively, is that the translation?
That is the translation.
Oh, Douglas, I did not kick off with this because I don't want to be a homer. Like I don't want to. This is tough to talk about.
What do you
So
mean?
Chinese stocks went up about 16% last week.
True story.
Leading the charge for that was JD, Alibaba, a few others.
Yep.
I've told you on the show, Alibaba's my top holding in the outside of my quantitative portfolio. We've talked about it almost since the show started. It has been as low as something like $60 a share. It's currently trading around 110.
Yep.
And most of that happened last week. I mean, last week was like a move 90 to 110. So the David Tepper interview floored me. I don't follow Squawk Box. I don't watch it. I don't, right? Like, it's not of interest to me. But he is so passionate about, and the backstory, if you watch more of the interview, sounds like he called those guys up post the China stimulus and said, I need to come on the show. I want to talk about China.
Yeah. Yeah. And one of the things we're not playing out here, and this gets to, we're not playing a part of this interview, and this gets to Wonkville, a little bit of Wonkville. And if add some color, call me out, whatever comes up here. But the bet that he's placing here, in addition to what he talked about around fundamentals and cash and all that, the current macro bet of why he's saying doubling down, tripling down, who knows what he's doing, but he's downing. He's Churchill Downs, this guy. What he's doing is he's saying that when the US is bringing down rates, and he's betting that the Fed is going to do what the Fed has stated it's going to do, which means that if you look at the difference between where interest rates were and where inflation is and where they want it to go, there's a gap. And some of that gap will be closed. This is what he's saying the Fed's going to do. If you look at the dot plot, right? The dot plot is what the Fed's best guesstimate of around their intention for the future. If you look at that, Fed's going to continue to lower rates. If the Fed lowers rates, then this is the bet he's making. If the Fed lowers rates, then China then says, okay, on one hand, our exports can become more valuable because there's a devaluation of the dollar. So that happens. Our currency relative to the dollar can become more valuable. And so therefore, if we're going to stimulate, this is a time to throw all the monies up in cha-cha. That is the macro bet that he's playing in addition to the fundamentals.
Well, and like you alluded to it, but there's more than that. So one, he's saying the US Fed, based on their language, like, I'm not a macro investor. I don't follow this stuff. He said he feels they've already committed to 3 more rate cuts in the near future.
Yep.
That's going to stimulate equities in this country. And then China's playing off of that, but China just released this massive stimulus package. So China's version of the Fed is spending 12 trillion yuan for greater financial supports for, I mean, the list goes on and on. I have an article in front of me of all the different facets that they're spending. They're planning on boosting domestic consumption. How does that clearly benefit JD and Alibaba? It clearly does. So I think his larger bet is, hey, you look at some of these deals in China. He alluded to it with the fundamentals of these stocks, which drew me to these companies. And then you say they're spending on this side of the Pacific, they're spending on that side of the Pacific, and just don't fight it, man. So he has the whole interview is fascinating, but there's another piece of that interview where they ask him what specifically he's buying, and he just says everything. Like, he's
everything.
just saying everything. I'm blown away by it.
Yeah. I also, when you were saying you don't have it quite in front of me, but there's a lot of stuff that the Chinese stimulus package is trying to do. What I love is in this, and we will put this on the Substack, Skippy Doogles at substack.com, so you can watch this video. What I love is that he holds up a piece of paper. Like, he brought in the printout of what China said it's doing. He holds up the piece of paper and he's like, did you see this? And it's so, for me, the reason I love that is because you can get your quantitative models, your algorithms playing out, and he's just holding up an 8.5 by 11 sheet of paper and being like, these words, that's all it takes is this printout, this wrinkled printout. I loved it.
So I've held Alibaba for a long time. That looks like a quality investment on my end. I purchased JD to diversify away from Alibaba because ultimately at some point, whatever, 12 months ago, I realized that my bet with Alibaba was largely a bet on Chinese stocks because it was the most depressed stock market in the world, effectively. So I wanted to diversify away from that. And then you and I, what was this, Doogles? 3 months ago, we're texting about Yum C.
Yum
which
China.
Is Yum Brand's China version, which has these growth numbers like you don't see. I mean, you don't see in developed markets. And also had a really strong cash position and something. When we were texting about that, I don't even think it's 3 months ago. I was telling you to get in. It's at $30 a share. It's currently at $45 a share, like overnight.
Yeah. And this is one of these places. Let's say that all these Chinese bets work out, which I hope they do, because you're all up in it. I got nothing against that. I love it. This is one of these places where human psychology, you can get past all the fundamentals, or can't get past all the fundamentals and just get in your own way. This is Doogles here. Because if people have been listening to this show for a little while, you know a few things have happened. The very first episode of this here podcast, we were talking about China Mobile. I bought China Mobile. Trump was like, nah, bruh, you can't trade. I mean, like he can do that himself. You know what I mean? But he, yeah, Trump was like, nah, bro, you can't trade, bruh. No, but so the government, US government, banned China Mobile. And so China Mobile was delisted. Boom, Doogles. I had Tall Education Group, a Chinese education company. China came out and said, education is not something you can make a profit on. Tutoring in this country. Tall Education Group got hit. I bought Alibaba with you. I've gone through so many stressors with China over the last few years that I see all these things and I'm just like, I just can't. And it's fine, right? In the long run, it's fine. It doesn't really, but I'm just like, I just can't with China right now. Like, sorry, China, I just can't with you.
But so that's incredibly relevant because I won't let these positions run nearly as long as I would. We talked about this with is Alibaba investable many years ago, right? It was like, oh my goodness, it's so cheap and the growth potential is great, and you get access to an entirely different portion of the world than you do with Meta or Amazon or whatever. It was so tantalizing, but it was really tough to get comfortable with. But now these companies, they've caught fire, and it's amazing because most of them have incredible balance sheets. Most of them are buying back stocks. And now most of them have their hair on fire with Chinese stimulus and potentially more money flowing from the US. Like Alibaba specifically opened up share purchases to the Asian market within the past 3 weeks. So it was really hard for someone in China to actually own Alibaba, the company, until recently. There's all sorts of additional demand coming from that. I mean, I don't know. That's the hard point now, Douglas. I've made nice returns on all these things, and I got to decide how to exit because I don't want this much China risk on my personal balance sheet, right?
As much as you say that, you keep accumulating. You're like David Tepper. David Tepper. Now I can't even say the man's name. Like, making me sneeze.
Okay, so one more thing that David Tepper said, which the whole interview is amazing because theoretically you can call him one of the more successful investors of our era or whatever. Like I said, I'm not a huge fan, but whatever. He talks about how he had self-imposed holding limits, specifically with Alibaba, which I think is his biggest holding now. And those were somewhere around 12% of his portfolio. And he's basically going back and forth to the host, including Becky Quick, who cracked me up because we saw her in Omaha, right? But basically going like, she's going, what about your rules? And he is saying without saying, like, I don't care at all about my rules, strongly implying that he holds like 25% of his portfolio in Alibaba at the moment. It's just fascinating. You see the human psychology of how challenging investing is for everyone, for your mom and pops and your professional investors that make $2 billion a year.
I think I've said this on this pod before, but it reminds me of one time where you've seen Rounders, right?
Yeah, it's been a while though.
So in the movie Rounders, which for those that have not seen it, go watch it right now. What are you even doing? Rounders, late 90s movie, Matt Damon, poker, love the movie.
Mm-hmm.
There's this point in the movie where Matt Damon goes and he plays poker in Atlantic City. And when he sits down, it's basically all the same people he plays poker with in New York. And they're like, why do we even come down here if we're just going to play together? This happened to me one time. I used to play poker back in the Bay Area. There was a spot I went to. I flew to Vegas, sit down at this table, and it's like half the people that I play poker with over in the Bay Area. And so basically what we did was let the other seats play out. Like we just kind of sat there and the people would come sit down. But this one dude during this, the reason I'm telling this one dude at some point, he says to me, some guy sits down, plays a couple hands, and that was the fish. Like it was very obvious that was the fish. The fish being someone that cannot play very well. And he said, sometimes you just got to wait, man. And when they sit down, you jump on that saddle and you ride them like Seabiscuit. This is his Seabiscuit. This is what David Tepper saying. He's saying, when you see it, you got all these rules he has all these rules for himself to regulate, in general. But when the whale comes, hop up on it. That's what he's saying.
That's an incredibly, for those who haven't been through it, and I assume all the listeners pretty much have at this point, but we have a lot of listeners that just do the index thing very wisely and are great investors. But man, it's so challenging. I've been telling you for years now, I felt the agony of owning something like Alibaba. And then in an instant, in 5 days, your returns can go to a very sweet spot. And I still, Doogles, this whole week was going, gosh, was it worth all the pain and torment I put myself through?
That's right.
For China exposure? Like, this is not fun. The outcome's going to turn out great. This is not fun at all.
All got to make our own decisions. There you have it. I hope you enjoyed those highlights from 2024. As always, SkippyDoogles.com is our one-stop shop. SkippyDoogles@gmail.com is where you can send your listener mail. And here's to a wonderful 2025. Thank you, everybody.